Hello everyone, welcome to Unit 4, Lecture 3. So in today's discussion, what we will first start off discussing is the future of the financial industry, and then we will move into some different types of investments. So far in our previous two lectures, we've been talking about banks and their balance sheet items, their off-balance sheet items. How do we measure the success of banks? What are their, how do banks make money? Now what we'll turn our discussion to, or our attention towards, is the future of the financial industry. So what we're going to do here is present three challenges and three opportunities of banks in the upcoming years. So challenge number one deals with pension underfunding. So managers that were handling trillions of dollars in government-run pension funds never expected rates to stay this low for so long. So take a look over at the chart on the right. You can see that there has been diminishing returns on the yields of global government bonds, and these low yields has led to a major underfunding, which is the inability to continue to pay retirees their promised pensions. So these decades of underfunded just means that the liabilities, so the obligations to pay pensions under these defined benefit retirement plans, exceeds the assets in the investment portfolio. So decades of this underfunding, where liabilities are exceeding the assets, benefit overpromises, government austerity measures, and two recessions have left many retirement systems with deep funding holes, meaning that they are unable to pay retirees their promised pensions, and as a result, governments have responded by cutting pensions and jobs. Pension underfunding is something that is certainly a challenge moving forward in the financial industry. Challenge number two, insurance struggles. So insurance companies also are struggling due to these very low interest rates. So life insurers earn much of their profit by investing customers' premiums in bonds until the claims come due. As the Fed began driving down rates in 2008 to rescue the economy, so what they are trying to do is provide the ability to borrow at these low rates, so to rescue the economy from this global meltdown, the yields on corporate bonds and also government bonds has tumbled. As a result, insurance companies have responded by raising their premiums for customers, so much so that customers can no longer afford insurance. So we have pension underfunding, insurance struggles, both kind of tied to those low interest rates. The third challenge is cybersecurity. So what happens in cybersecurity, or with cybersecurity, is hackers infect banks' computers and demand ransoms. According to Joe Leonard, Senior Vice President for Technology and Chief Information Officer for the Federal Reserve Bank of New York, there will be a cyber-driven financial crisis within the next 10 years. That's what he is expecting. Different types of cyber attacks include malware, which is simply viruses or spyware. You have phishing, which is fraudulent attempts to obtain sensitive information. You also have denial of service, and there's also cryptojacking, which is running someone else's computer. So these are just some different types of cyber attacks that are out there. The severity of this crisis that Joe Leonard predicts depends on how well we prepare for it. And when a breach does occur, you need a playbook of communications prepared to lessen the panic and to clearly convey what's happening to the public. Now, cybersecurity is something that also is important in our own daily lives, for our own personal information. There are ways that you can protect yourself from cybersecurity. Just some examples would be strong passwords, updated software, two-factor authentication. There's a lot of different ways that you also can protect yourself from cybersecurity. So those are three challenges of the financial industry moving forward. Now three opportunities. Opportunity one is faster accounting. So technology speeds up generating financial statements. So you have faster accounting and turnaround time, closing your books faster. As accounting becomes more reliant on technology, companies are now closing their books faster by 4.5 days in 2017. Closing out your books is simply zeroing out your income and expense reports and recording what your net profit is. So having these results in hand earlier makes the decision-making for these banks easier and helps the organization become more nimble. So this is your ability to handle events and opportunities as they become present. This extra time allows the finance team to perform a deeper analysis, catch errors, and invest more time in planning for the next quarter. So faster accounting has certainly been a good development for banks and other financial institutions. The ability to be more nimble, handle events and opportunities, and just to be able to better prepare for the upcoming quarter. Opportunity two deals with blockchain settlement. So blockchain works as a tamper-proof shared ledger that can automatically process and settle transactions using computer algorithms, making payments faster, more reliable, and easier to audit. So one, blockchain actually increases liquidity. Two, it shows accurate values, so there's more transparency and assurance. And when you hear the term blockchain, block just represents the digital information. Chain represents the public database and where this digital information is stored. So blockchain is simply digital information, the block, stored in a public database, the chain. According to Blythe Masters, blockchain technology or distributed ledger technology is just a way of using the modern sciences of encryption to enable entities to share a common infrastructure for database retention. Basically, what we saw before was that different departments of different companies had separate records of different transactions, and so there was a lot of time that was wasted trying to reconcile these different records. If you have blockchain, everyone uses the same ledger to record their transactions. Each party has access to this ledger by using a password, and then everything is encrypted. So it certainly has increased liquidity, increased transparency, and eliminated some of this time needed to reconcile these different accounts. Blythe Masters went on to continue to say that an enormous amount of time is spent reconciling the differences between records kept in distinct databases that ultimately refer to the same transactions between two parties. So what this blockchain technology allows to happen is that these transactions are able to happen more quickly. What this blockchain technology allows you to do is essentially share and replicate information in a secure or encrypted environment between different nodes or different points on a network. And Blythe Masters believes that settling transactions on a blockchain instead can save the banking industry billions of dollars. We'll talk about it a little bit more here coming up. But second opportunity is blockchain. Last opportunity that we're going to discuss is analytics. So big data is the foundation for 21st century financial skills, and finance professionals should lead the charge. To turn larger amounts of data into better business insight. This was a statement made by William Fussler, a global financial strategy and transformation leader for IBM Global Business Services. Business analytics is a field that analyzes big data and communicates business insights gleaned from the data. OU actually offers a business analytics co-major or minor, something that you might want to consider. But the skills, four key skills in business analytics include first, understanding what business needs to find out from the data. So basically what is important from the data for these different businesses. 2 would be collecting the data in a usable format. 3 is analyzing the data to answer key questions. And 4 is communicating the results. So data storytellers. The communication of these findings is what's key. You can think of your way of being able to add value to a company as bridging the gap between a computer scientist or an IT professional who's really good at dealing with the technology, and then bridging that gap between those people that are purely business, looking at how do we actually add value to our existing customers. So with business analytics, you are collecting the data, turning the data into a way that how that company can actually add value to their existing customers. So that is our third opportunity. We will conclude the future of the financial industry by looking at, first of all, let's just look at this financial industry and technology, kind of going back to our discussion on blockchain. So according to 2019 Banking and Capital Markets Outlook, Reimagining Transformation, while the wild enthusiasm with blockchain has tapered off, the industry still continues to sail towards a blockchain future. However, the energy might now lie with artificial intelligence and cloud, as they are already transforming many aspects of banking in significant ways. One way that you can prepare yourself for the future is learning the basics of coding. So coding in the banking industry, according to efinancialcareers.com, in 2018 you had C++, Python, and R being the top programming languages in demand in the banking sector. What are these different programs? C++ is the backbone for many banks' legacy systems that are still in use today. But there is a lack of specialists, as it is not as common with younger programmers. It's also enjoyed a renaissance of sorts with the influx of high-speed trading due to the need to process high volumes of data. So C++ is an older language. It does allow for the coding of large data, something that you may want to consider looking into is C++. OU is actually offering a finance a financial programming certificate where you take a class on coding. So that would be another thing that if coding is something that interests you and you would like to gain some more information about it, you might look at the financial programming certificate that Ohio University offers. Then you have Python. So used primarily for pricing, risk management, and trade management platforms, Python has progressively become one of the go-to programming languages at investment banks and hedge funds, replacing Java in many instances. And then you also have R, which is often used in conjunction with Python. It's also very popular, though not quite as ubiquitous. A quick perusing of job postings requiring experience with Python usually asks for exposure to R. Now, there are some free resources for coding. So Codecademy would be one that I recommend taking a look at. There are free and paid versions within Codecademy, but a way that you can kind of begin learning how to code, which is something that is very important here in the banking industry. So that is the future of the financial industry, 3 challenges, 3 opportunities. Now what we will move into is different types of investments. So what we'll be focusing on here are mutual funds, ETFs, and hedge funds, and we'll also discuss venture capital. So this material comes from Chapter 17 in your textbook and also some supplemental material. Our learning objectives today are to understand what are the advantages of a mutual fund, what are the different types of mutual fund investments, what is passive versus active management with mutual funds, what are mutual fund fees, what is an exchange-traded fund, an ETF, who are hedge fund investors, and what are the differences between mutual funds, ETFs, and hedge funds. So we will start off with mutual funds. Mutual funds are simply pooled funds from multiple investors. Mutual funds provide opportunities for investors to invest in a liquid, diversified portfolio with high upfront costs. So let's consider a situation. Let's imagine you want to create a portfolio of 1,000 different stocks, and you want to create this portfolio yourself. Let's assume that each share of stock, each one of those 1,000 stocks that you want to have in your diversified portfolio costs $100. So to create this diversified portfolio of 1,000 stocks, buying 1,000 individual shares at the assumed price of $100 would cost you $100,000 to create this diversification. On the other hand, a single share of a mutual fund represents ownership in thousands of firms, and that cost could be $100. So what you can do with a mutual fund is you can actually obtain some level of diversification, which is with a much lower upfront cost. Also, the trading costs are lower since mutual funds can buy and sell in large blocks by pooling money of individual investors together. One thing with mutual funds to keep in mind, one disadvantage, is that your voting rights with individual stocks belong to you, but within a mutual fund, you delegate your voting rights to the portfolio fund manager. So that is one disadvantage of mutual funds. You do have ownership in these different companies included within the mutual fund, but you are not a voting member. So next, some different types of mutual funds. First off is money market mutual funds, so MMMFs. These are short-term securities, so less than 1 year. And we'll talk about some examples here on the upcoming slide. We also have income funds, which invest in government and low-risk corporate debt. You have bond funds who invest in fixed income securities with a maturity of over 1 year, which have varying risk levels. So there are 2 main types of risk levels, and you think back to our bond discussion earlier this semester. You have investment grade bonds, which are a high rating, and then you have your non-investment grade, your high yield bonds, which would be the more riskier types of bonds. But those are your 2 main types of risks when you're talking about bond funds. You also then have equity funds. So one type of equity fund would be based on the different type of companies included within the mutual fund, large cap, mid cap, small cap, based on market capitalization. And then you could also have equity funds that focus on value versus growth. Value being a high book-to-market ratio, growth being a low book-to-market ratio. Another type of mutual fund would be balanced funds. Balanced funds are both stock and bonds. So you can see you can have a 60-40 split, 50-50 split, whatever your desire is on these balanced funds. But the key is that you understand that stocks and bonds. You can also have international funds, international mutual funds to invest in foreign companies, stocks, or bonds. There are then sector funds, which are stocks in different industry sectors, so financial sector, the technology sector. Also have socially responsible funds who only invest in companies that meet certain criteria. So it may screen out certain companies like tobacco companies or defense companies. Those are socially responsible funds. And then we also have index funds. Index funds track the performance of some market index, such as the S&P 500. So let's first talk about money market mutual funds, our short-term securities here. So money market mutual funds are very similar to a bank's MMDA, so think back to Lecture 1, your money market deposit accounts, except that mutual fund versions offer a higher interest rate, but they do not offer your FDIC deposit insurance coverage. However, there was one unique circumstance that when investors went and pulled $200 billion out of mutual funds after Lehman's collapse during the financial crisis, the U.S. Treasury extended coverage to money market mutual funds for 1 year. So basically, there was some deposit insurance for that 1 year, but this did cease in 2009, and there is no current FDIC or Treasury deposit insurance coverage currently on mutual funds. Money market mutual funds continued. Money market funds hold T-bills and commercial paper. We talked about this in Unit 1. And they also hold bankers' acceptances. So what is a banker's acceptance? A banker's acceptance is a short-term debt instrument issued by a company that is guaranteed by a commercial bank. Bankers' acceptances are issued as part of a commercial transaction. These instruments are similar to T-bills, are frequently used in money market funds, and are traded at a discount from face value on the secondary market, which can be an advantage because the banker's acceptance does not need to be held until it matures. So basically what this means, or what this is saying, is that bankers' acceptance are another type of money market investment and simply a short-term debt instrument issued by a company that is guaranteed by some commercial bank. Next, within mutual funds, there are passively managed funds versus actively managed funds. What does this mean? Well, passively managed funds are often following index funds. These index fund managers passively buy and hold securities with weights similar to a market index. So one example would be the S&P 500 index. In contrast, actively managed fund managers select, buy, and sell securities with the goal to beat some benchmark. So that benchmark for equity could be the S&P 500. For bonds, it could be the Barclays Aggregate Bond Index. There's different benchmarks, but with actively managed funds, they're trying to beat some benchmark. Looking at the percentage of large cap funds that underperform the S&P 500 index, research shows that after fees are and we'll talk about fees here of mutual funds coming up, but after fees are included, you will often be better off with an index fund rather than an actively managed fund. So this is according to CNBC. You can see that in 1 year, 64.5% of these large cap actively managed funds underperformed the S&P 500 index. Notice that after 15 years, that percentage went all the way up to 91.6%. So it would make sense that if you have a long holding period, that you would just hold some index, for example, the S&P 500 index fund, rather than an actively managed fund. Interestingly enough, though, it is the actively managed funds that allow the market to be more efficient. So an efficient market is where the securities prices are more accurately priced. So it is important to have these actively managed funds as they help the market be more efficient. Next, we have open-ended funds versus closed-end mutual funds. So with open-end mutual funds, investors can buy new shares at any time and redeem them for their fair market value. The number of shares then will fluctuate daily. So the number of shares within the mutual fund fluctuates daily with new purchases and any share redemptions. With a closed-end fund, investors can only buy new shares at a set date, but can trade then in the secondary market. Because the number of shares available for this closed-end fund is fixed, closed-end funds can trade for more or less than the value of their underlying shares based on the demand for shares. So they may be slightly mispriced. And due to this possibility of being mispriced, closed-end funds became very popular by those investors that were trying to purchase these closed-end funds below their market value, below what their actual value was. But now there is a declining role of these closed-end funds, playing less of a role in the marketplace, as there has been more of a rise of ETFs, exchange-traded funds, and we'll discuss that more here shortly. So a mutual fund's price is determined by calculating the NAV, the net asset value. So mutual funds are usually marked to market at the close of the day by calculating the net asset value. These, again, at the end of the day would be open-ended. Closed-end do not have to calculate net asset value daily. So net asset value is the daily market value of the fund's assets, so such as the securities included within the fund, minus any liabilities. So, for example, operating expenses. And then you take that and you divide it by the number of shares outstanding of the fund itself. In this class, we will not be including any liabilities in our net asset value calculations, but realize that that is something that is deducted from the market value of the fund's assets before dividing by the number of shares outstanding of the fund itself. So basically what you're doing when calculating net asset value is you use the closing price of the shares in the portfolio and you multiply that by the number of shares of that stock in the portfolio, and you do that for each share or each stock in the portfolio. Add all those values together, and then you divide by the number of shares outstanding of the fund itself, not the number of shares in the portfolio. So how many shares of the mutual fund are outstanding, not the number of shares that are included within the mutual fund. So the number of shares outstanding will be provided for you in this course, but realize that you're not dividing by the number of shares in the portfolio, you're dividing by the number of the mutual fund shares that are outstanding. So let's do an example. An open-end mutual fund owns 1,500 shares of Unilever priced at $12, owns 1,000 shares of Danone priced at $43, and 2,000 shares of Pepsi priced at $50. The fund itself has 14,000 of its own shares outstanding. That's the number of shares within the fund that constitute the fund, not the number of shares of stock that are in the actual mutual fund. And then, so what is the net asset value of a fund's shares? So what you would do is you would take the number of shares times its price, plus number of shares times its price, plus number of shares times its price, add those up, and then you divide by the number of shares within the fund. So we have our values here, so we're going to take 1,500, multiply it by 12, add to it 1,000 multiplied by 43, add to it 2,000 multiplied by 50. We take that and divide by the number of shares of the fund, and we get a net asset value of $11.50. So that is how net asset value is calculated. Let's do another example. This one is not in the course pack, but you can kind of follow along. Once again, we have an open-end mutual fund, 18,500 shares of 3M, priced at $231, 17,000 shares of Accenture, priced at $147, 23,500 shares of TJ Maxx, priced at $70. The fund itself has 85,180 of its own shares outstanding. What is the net asset value of a fund's shares? So once again, we are taking the number of shares times its price, plus the number of shares times its price, plus the number of shares times its price, and then dividing it by the number of shares outstanding. So what we have here is 18,500 times 231. You can break it down even further to show exactly what's being multiplied here, plus 17,000 times 147, plus 23,500 times 70. Take the sum of those products, divide by the number of shares within the fund, 85,180, and we get a net asset value equal to $98.82. So that's essentially the price of the individual share within the mutual fund. Now, obviously, in real life, mutual funds are going to hold more than 3 stocks. They could hold 200 stocks, but the number of shares outstanding will also fluctuate on a daily basis as people enter and leave the fund. But these are just some pretty basic examples on how to calculate net asset value. Next, let's discuss the different fees that are associated with mutual funds. The first is an expense ratio. So the mutual fund operating expense paid indirectly by investors. They say it's paid indirectly because the returns are then reduced by this expense, by this operating expense. So this would be your liability that is taken out from the asset part when I first talked about mutual fund net asset value calculations. That's what it means to be paid indirectly. You then also have load funds, which is a mutual fund with an upfront sales charge. You also have back-end load funds, a mutual fund with a charge when the investor sells. And then you also have, to save money, you should look for no-load funds. So it's important to remember that high fees do not guarantee good performance. So one way to save money is to look for these no-load funds. You also have management fees, which are a fee charged to manage the investment, calculated as a percentage of assets within the mutual fund. You have a 12B1 fee, which is the fee charged to cover distribution and marketing expenses. You also have the redemption fee, which is charged when investors sell, in addition to the possibility of the back-end load fee that we discussed earlier. And to take a look at some of these fees, you may want to look at the FINRA Fund Analyzer. They give details on each of the fund's fees. So if you want to look into this a little bit further, go to the FINRA website and look at the Fund Analyzer on these different mutual funds. So last up, pros and cons of mutual funds. Pros, it allows you to have the diversification without the high upfront cost. You receive the economies of scale due to the pooled money of the different investors in the mutual fund. It's another pro would be its simplicity, the variety, and the transparency. Some cons would be the fees, especially for your actively managed funds. You also have dilution. So when investors buy into the fund, it's going to dilute the value of the existing shares. And trading only occurs at the close of the day. We'll talk about how that's different here with our next type of investment. And then also taxes. So when you sell your mutual fund shares, you have to pay taxes on your gains. That would be another con, another way that this next type of investment can actually decrease the amount of taxes you pay due to the fact that it is traded on a secondary market. So kind of briefly start going into the next type of investment. The next type of investment that we're going to cover are ETFs, so exchange-traded funds. What is an ETF? An ETF is a marketable security that tracks an index or commodities, bonds, or a basket of assets like an index fund. These ETFs may be bought or sold in a brokerage account, just like trading shares in a common stock. So what's nice about ETFs is that it combines some of the advantages of mutual funds and the advantages of buying individual shares. So before we get into some ETF information, let's first just look at ETFs by the dates and numbers. So the first ETF was created in Canada in 1990 on the Toronto Stock Exchange. The first U.S. ETF was created in 1993. It was the S&P Depository Receipts Trust Series 1 called the SPDR. The best known ETFs are the SPDR, which is ticker symbol SPY, and the NASDAQ 100 ETF, which ticker symbol is QQQ. This ETF tracks the NASDAQ 100 index, which is the top 100 international and domestic companies on NASDAQ. So these are when they were first created. In the year 2000, there were 80 ETFs and $52 billion worth invested in these ETFs. 11 years later, by 2011, there were 1,300 ETFs and $1.1 trillion invested in these. And then by 2019, there was $4 trillion invested in these ETFs. So you can see that there has been quite the rise in popularity of ETFs over the past 30 years. So how are ETFs different from mutual funds? First, ETFs are different from mutual funds in the fact that when a mutual fund investor buys or sells, they receive the day's closing price. ETF investors receive an intraday market price. So for example, let's say you sell your mutual fund at noon. The price you receive is going to be the price of the mutual fund at closing, so the price at 4 o'clock. Whereas if you sell your price at noon, or if you sell your ETF at noon, you're actually going to get the current price of the ETF at noon that day. ETFs can also be sold short, just like common stock, while mutual funds cannot. So let's say you buy this ETF and you bet that the price of the ETF is going to go down. So what you would do is you would borrow a share of the ETF and then sell it. And then if the price of that ETF goes down, then you can buy it back at the lower price, return the ETF, and collect your profit. So ETFs can be sold short, unlike mutual funds. Trading ETFs also involves extra costs, so brokerage fees and bid-ask spreads. These are costs that are not applicable to mutual funds. And a retail investor cannot purchase or redeem shares directly from the ETF, but rather trades on an exchange. So often this sets up a lower capital gains tax for ETF investors. So that was one of the cons of mutual funds, were taxes. With ETFs, by them being secondary or traded on an exchange, this often sets up lower capital gains taxes on these investments. So ETFs generally have lower expense ratios than mutual funds, but it mostly reflects the difference between indexing, so that's your passive management, remember, from mutual funds, and active management. So let's take a look Well, first of all, index ETFs and index mutual funds have expense ratios that are lower than those of active ETFs and active mutual funds. So what we have here on the right is a chart from Vanguard. You can see that the passive the passively managed accounts have lower expense fees than the active managed accounts. You can see that even with an active management, that the blue here, your ETFs, has a lower expense ratio than your mutual funds. It's actually kind of interesting here for Vanguard. Their passively managed ETFs actually have a higher expense ratio than their passively managed mutual funds. But there's a lot of companies that have lower expense ratios for both passive and active ETFs than with mutual funds. So for example, let's take a look at an active ETF versus an active mutual fund. So we're looking over here at this part of the chart. On a $500,000 portfolio, you're going to save $550 per year by investing in the active ETF versus the active mutual fund. This is just some extra material to provide additional information about ETFs and how they work. So while legally classified as open-end funds, think back to the mutual funds, what it means to be open-end. ETFs are more similar to closed-end funds in that they are a fixed number of shares outstanding. Open-ending, those number of shares fluctuate. Closed-end, you have a fixed number of shares. ETF shares are created when an institutional investor, so an institutional investor defined is an entity which pools money to purchase securities, real property, and other investment assets. So ETFs are created when this institutional investor deposits specific securities with an ETF, receives shares in the ETF, and then trades these shares on an exchange. The individual investors can then buy or sell the shares on the exchange. When an ETF investor sells shares, shares are bought by a market maker who then turns around and sells them to another ETF investor. With mutual funds, if one person sells, then the mutual fund must sell off the share of the underlying stock to pay off the shareholder. So instead of, if you notice here with mutual funds, if one person sells, then the number of shares of that mutual fund would decrease. Whereas with an ETF, if one person sells, it goes to the market maker who then goes around and sells it to somebody looking to purchase that ETF. Some tips, again, extra material. Tips on ETF investing. The first tip is don't trade at open or close of the day. So oftentimes there's a lot of volatility in the stock market within the first 30 minutes or the last 30 minutes of the day. So by not trading at the open or close, investors improve their chances of minimizing transaction costs paid on ETF trades. Joel Dixon, Vanguard Group's global head of investment, made this comment or made this suggestion. He also advises using limit trades, which specify in advance the lowest price for a sale or the highest price for a buy that you're willing to accept. An alternative to is a marketable limit order. This is someone who wants to buy an ETF, setting a limit price at a few cents above the ask price, and then when selling, the investor might set the limit price at or a few cents below the bid. And then another tip is you want to steer away from ETFs with illogical or not well-described strategies. So you don't want to look at ETFs and just their performance over the past month or for the past 6 months. It may just be random that they performed well. You want to look for ETFs that are logical and have a well-described strategy. Next investment is hedge funds. What is a hedge fund? A hedge fund is an actively managed portfolio that may use derivatives, leverage, and sophisticated investment strategies in both domestic and international markets. So you're noticing here some terminologies of derivatives, debt, leverage, sophisticated investment. So there are a lot more risk taken on in these hedge funds with the hope of a higher return, risk-return trade-off. Hedge funds are for accredited investors. You can only purchase a hedge fund if you are an accredited investor. What is an accredited investor? These include high net worth individuals, so net worth of more than $1 million or annual income more than $200,000 or $300,000 if married. Also include large institutions where their total assets exceed $5 million. And the minimum investment in a hedge fund is typically $500,000 to $1 million, according to Forbes Hedge Fund Investing 101. So hedge funds in comparison to mutual funds. In contrast to mutual funds, hedge funds have much fewer restrictions on their investment strategies, so they can use much riskier trading strategies. They are also less transparent, and they generally have higher fees. Fees, there are two main fees that are included with hedge funds. First being a management fee, which is 1.5% to 2% of assets, regardless of the performance of the hedge fund. And then you also have a performance fee, which is typically 20%, which allows the manager to keep a percentage of the profits. Hedge funds, once again, some extra material. Hedge funds can use strategies unavailable to mutual funds, such as short selling, leveraging, program trading, arbitrage, and derivative tradings. Some popular strategies include long-short, long being where you would buy securities you think will outperform the market, or short-sell securities that you think will underperform the market. Another popular strategy is macro, so that's looking at macroeconomic trends. Another would be distressed securities, so you invest in securities of financially distressed companies hoping that they can recover, in which you would earn a high return, but there is high risk. Once again, the risk-return trade-off. And then market neutral. With market neutral, you take a market neutral position, so you don't think the market's going to go up or down in any particular direction. Essentially, what you're thinking is that you're going to pick some stocks that will outperform relative to the market. Hedge funds with below $100 million in assets do not register with the SEC. The performance is self-reported, so once again, less transparency. And then hedge fund failures. So there's plenty of hedge fund successes. A big one in recent times would be Scion Capital with Michael Burry, who predicted the financial crisis of 2008 and actually purchased a lot of credit default swaps on mortgage-backed securities. With this success, he earned over about a 400% return over an 8-year period on his hedge fund. But there's also been a lot of hedge fund failures. So you have the long-term capital management, which occurred in the late 1990s. Big failure with hedge funds. You had Bear Stearns, who purchased subprime mortgage-backed securities during the financial crisis or before the financial crisis, and eventually had to be bought out by J.P. Morgan Chase. And then you had the Bernard L. Madoff investment securities, which was found out to be a Ponzi scheme where Bernard was actually eventually prosecuted. But the main point here is to showcase that, yes, there has been plenty of successes within hedge funds, but there has also been many failures of very great magnitude. And so our last type of investment here, before we conclude this third lecture, deals with venture capital. Venture capital firms are investment firms that pool money from individuals and or institutions and invest the equity funds in startup firms. So what they do is they buy an equity stake. They are active investors who provide valuable expertise in the firms to the firm's managers, and they use scientific or business professionals to help them identify new technologies, promising new medical treatments, or other selling points of startups where it makes sense to invest their money. So an example would be these biotech firms that need funding to research cures for cancer and other diseases. This is very costly research. What you could do is find a venture capital firm to help with some of that capital needed. Private equity firms are very similar to venture capital firms, but typically deal with more existing companies that have a proven track record rather than the very new companies like venture capitals. Very similar to venture capitalists are angel investors. So angel investors are wealthy individuals or groups of wealthy individuals who invest their own money into companies. So that would be one where you think of the movie or of the TV show Shark Tank. Angel investors are very similar to these venture capitalists. So last up, reviewing the concepts. What are the two advantages of a mutual fund? One would be the diversification. So you're able to create a diversified portfolio and economies of scale, so without the high upfront costs. What does NAV mean? That is your net asset value, so the daily market value of the securities divided by the number of shares outstanding. So net asset value could be thought of as the price of the mutual fund. What is an index fund? So this tracks a market index, passively managed. What is an actively managed fund? This buys and sells securities that they believe will outperform some benchmark. What is a load fund? So that is a charge when the investor buys into the fund. What is a management fee? So they manage the portfolio, some percentage of assets. What is an ETF? An exchange-traded fund. How are ETFs different from traditional mutual funds? You have your market intraday price rather than a closing price. You have different fees. You can sell ETFs short. Next question, who are the two main types of investors in hedge funds? You have your accredited investors and your large institutions. And last up, how are hedge funds different from mutual funds. So you have higher fees, less transparency, riskier strategies. And what are the two main types of fees? You have your performance fee and your management fees. So this concludes Lecture 3 of Unit 4. I realize it was a little long. Hopefully you learned some very valuable information. Don't forget to complete your Lecture 3 check-in question, and I will talk to you all soon.